Hello, welcome to our Chapter 2 lecture. So in Chapter 2, we're going to continue our study of analyzing transactions. So we introduced this topic in Chapter 1. We're going to continue it now in Chapter 2. So businesses engage in transactions and events. And what we learned in Chapter 1 was that all of these transactions, when we measure them, we have to determine how they impact or the effect they have on the accounting equation. And that's what we're going to do. We're going to continue to do that in Chapter 2. We're going to look at the transactions and determine how they affect the accounting equation. But we're going to do that now by expanding that accounting equation, because every accounting equation is made up of multiple accounts, if you will. And these accounts, all of these accounts, for example, are going to be a part of our our basic equation, which is assets are equal to liabilities plus equity. And we have a variety of different kinds of assets, right? And for every asset, we have an account. For every liability, we have an account. For every equity, we have an account. So for example, we have cash, right? We've got an account for cash. We have supplies. We're going to have an account for supplies. We have land. We'll have an account for land. We have accounts payable. We'll have an account for accounts payable. We have common stock. We'll have an account for common stock. Every item that makes up these elements in the accounting equation will have an account to represent it. And an account in its simplest form has three parts. Every account, every asset, every liability, every equity is going to have a title, right? That's important for us to be able to distinguish them. Uh, we need a title, and we need a way of increasing the accounts, and we need a way of decreasing the accounts. So for every account, we need to at least have that, a title, an increase side, and a decrease side. Now, this is kind of an expansion of what we did in Chapter 1, right? Again, we had our assets, we had our liabilities, and we had our equity, right? And the basic equation is that our assets are always going to be equal to our liabilities plus our equity. And now we're saying that every account, right, is going to have a title, and we need to be able to increase those accounts. We need to be able to decrease those accounts, right? Every account that we call an asset, right, we've got listed here. Every account that we call liability is listed here. Same thing for equity. All those equity accounts, right? The common stock, the dividends, the revenue, the expenses, they're all listed there. We need to have titles. We need to be able to increase them. We need to be able to decrease them. Now, let's talk about more formal descriptors of these accounts. The basic account form that we're going to use is called the T account. It's called the T account because it kind of looks like a T, right? And we've got those three things. We've got the title. Every account has to have a title. Every account has to have a way of increasing it and a way of decreasing it. So what we're going to say is every single account is going to look like this. It's going to have a title. It's going to have a left side, and it's going to have a right side. And the left side we're going to call the debit side. The right side we're going to call the credit side. It doesn't matter whether it's an asset, a liability, or an equity. Every single account is going to look like this. It's going to have a title. It's going to have a left side. That's the debit side. It's going to have a right side. That's the credit side. And this is an example of an account. This is the cash account. It's got a left side, right? That's the debit side. And it's got a right side. That's the credit side. And all of our transactions have been recorded in this account. And in this case, the way we determine the balance in this cash account is by netting all of these items on the left side and the right side. So the amounts on the left side are greater than the amounts on the right side. So we end up with a balance that is on the left side. So essentially we're saying 25,000, add that, add 7,500, and then subtract that, subtract that, subtract that, subtract that, and we end up with 5,900. That's how we balance an account. right? Take all these amounts on the left side for this cash account, subtract all the amounts on the right side, and we end up with a balance of 5,900. So in general, that's how assets are going to work for us, right? If we've got an asset, the left side's the debit side, and that is in fact the increase side. The right side is the credit side, and that is in fact the decrease side. And all assets are going to behave that way. And the excess of the debits over the credits is going to be the balance in the account. And we'll talk a little bit more about the other accounts, the liabilities and the equity in a few minutes. So the next thing, we're going to introduce what we call double entry accounting. All businesses are going to use what we refer to as a double entry accounting system to record the effect of our transactions on the accounting equation. Every transaction that we record has to affect at least two accounts. And the total of all the debits that we record has to equal the total of all the credits. And this double entry accounting system has specific rules that we're going to use for debits and credits. And this system of double entry accounting is what we use in accounting. It's kind of like a special language that applies in all accounting courses, right? We're going to use it from now to the end of the session. And whether you're taking an introductory course or an advanced course, the rules are the same. So here are the basic rules that we have for all of our accounting equation items. So the assets, the liabilities, and the equity. So our basic rules are double entry accounting rules, or we also refer to them as the debit and credit rules. So again, every account looks like this. Debits on the left, credits on the right. Doesn't matter whether it's an asset or a liability. Debits on the left, credits on the right. Equity, debits on the left, credits on the right. Every account looks like this. Now, the difference is for assets, the way we increase an asset is with a debit. The way we decrease an asset is with a credit. That's true of all assets. Doesn't matter what kind of an asset it is. We want to make sure that this is how we account for the asset. When we increase that asset, we'll do it with a debit. When we decrease that asset, we'll do it with a credit. And liabilities, well, they're just the opposite of assets, right? Assets are things that we own. Liabilities are things that we owe. So they have opposite effects. That means if we want to increase the liability, we're going to do it with a credit. If we want to decrease the liability, we're going to do it with a debit. And equity, well, it's a lot like liabilities. If we want to increase equity, we'll do it with a credit. If we want to decrease a equity account, we want to do it with a debit. Those are our basic debit and credit rules for the assets, the liabilities, and the equity. Now, remember that equity has several divisions, right? There are several divisions or different kinds of accounts that make up equity. And we talked about this in chapter 1. So equity includes revenue and it includes expenses, right? So we've got other accounts that we've got to include with these debit and credit rules. So revenue accounts, if we want to increase our revenue accounts, we're going to do it with a credit. If we want to decrease our revenue accounts, we'll do it with a debit. And our expenses, well, they're just the opposite, right? Expenses decrease equity. So if we want to decrease equity, we'd have to do it with a debit. And if we want to increase it, we'd have to do it with we want to increase equity, right? Increasing equity happens with a credit, and expenses typically decrease equity. So we record expenses with a debit, and if we want to decrease our expenses, we would do it with a credit. In addition to revenue and expenses, we also have the dividends account. Remember, so the dividends account decreases equity. The way you decrease equity is, of course, by debiting it. So if we want to increase our dividends, we're going to do it with a debit. And to decrease our dividends, we'll do it with a credit. So those are the basic debit and credit rules for the assets, liabilities, and the equity accounts, including revenue, expenses, and dividends. Put it all together, and it kind of looks like this. Now what we have is basic rules of debit and credit, normal balance and normal balances of the account. So let me review what I just covered. So again, we've got assets are always going to be equal to liabilities plus our equity. And debits are always on the left, credits on the right. Doesn't matter what kind of an account it is, right? Assets, liabilities, or equity. Debits on the left, credits on the right. Debits on the left, credits on the right. Debits on the left, credits on the right. And the divisions of equity, dividends, revenue, and expenses. And notice we added something here. It's called retained earnings. What's that? Well, retained earnings is a summary of everything down here, right? Retained earnings, kind of self-explanatory. It is the retainment of earnings. So the revenue minus the expenses gives us income, and dividends is the distribution of our income. What's left over is called retained earnings. Retained earnings is the accumulation of our earnings minus our dividends. So retained earnings is kind of the summary of these three accounts over time. That's all it is. So the basic rules here, debit and credit rules. For assets, we're going to increase them with a debit, decrease them with a credit. Liabilities, just the opposite. We'll increase with a credit, decrease with a debit. Let me also point out here that in addition to the basic rules of debit credit, we're talking here about normal balances, or what kind of a balance should we have in the account. Well, the normal balance is always going to be the increase side. Whatever you increase an account with, that's going to be your normal balance. Assets are increased with debit, so normally assets should have a debit balance. Liabilities are increased with credit, so normally liabilities should have a credit balance. Common stock is increased with credit, so normally common stock should have a credit balance. Dividends are increased with debit, so normally dividends should have a debit balance. Revenue is increased with credit, so normally revenue should have a credit balance. Expenses are increased with debits, normally expenses should have a debit balance. And retained earnings, well, it should be earnings. So earnings are increased with a credit, normally retained earnings should have a credit balance. Okay, so that's a summary. And what you want to do here is you want to commit this to memory. We're going to be using these debit and credit rules from now until the end of the session. You don't want to have to keep going back to your rules and asking yourself, okay, how do I increase the debit? No, you need to have it committed to memory so that you can go through your assignments without having to constantly refer back to this summary of the debit and credit rules. So commit today to making sure that you have this table committed to memory. Next, let's look at kind of a few examples, right? Because what we want to do for every transaction is we want to record the transaction, right? Every transaction that has two effects, right? It's going to affect at least two accounts. And we're going to use those debit and credit rules, and we're going to record the transaction in what we call a journal. And a journal is essentially just a record of the transaction, right? It's a record or a list of the transactions. So let me give you just a couple of examples here. Let's say that Net Solutions paid $20,000 for the purchase of land as a future building site. So they paid $20,000. So, we got some cash here, right? They're paying $20,000 in cash. So if they're paying cash, we've got to decrease. Cash is flowing out, and cash is an asset, right? And they bought some land, right? So we have this land. We have an increase in our land, and land is an asset. So that's how you want to think about this transaction. We got two assets. We got to decrease cash, and we got to increase land. How do you increase an asset? Well, you increase an asset with a debit. How do you decrease an asset? Well, you decrease an asset with a credit. So the way we record this transaction in our journal, right, is to record debits first. We're going to debit the land account for the amount of the transaction, $20,000, right? So we label everything here, debits on the left and credits on the right. So we have a debit to land for 20,000 and we have a credit to cash for 20,000. Notice the debit is here and the credit is indented. There's an indentation here, and the indentation is for all credits. And then just a short explanation. And the link from this journal entry to our accounts, right? Remember the accounting equation. We need an account for every account in the accounting equation. We have this land account. Here's our T account. Debits on the left, credits on the right. We debit the land account for $20,000. We'd have a cash account. It's an asset. We credit it for $20,000. There it is. So that's how we record the transaction, in this case, for the purchase of land for $20,000. Let's do one more, and then we'll move to a more formal illustration. So in this case, this company is buying supplies on account. Supplies, right? This is an asset and it's on account. So they're buying these supplies. We got to show the increase in this asset. And they're not paying cash. They're offering their promise to pay. They're setting up an account and they have an obligation or a liability now. So we need an increase in an asset and an increase in a liability. How do you increase an asset? By debiting it. How do you increase a liability? By crediting it. So we're going to debit this asset called supplies for $13.50. We're going to credit this liability called accounts payable for $13.50. That's our journal entry. And the link to our accounts, these 2T accounts, debits on the left, credits on the right. Debits on the left, credits on the right. We're going to debit the supplies account for $13.50. We're going to credit accounts payable for $13.50. So that's an illustration, another second illustration on recording these transactions using double entry accounting. Now, I'd like to take you to a little bit more formal illustration. So this illustration, if I can find it here. So the illustration that I want to use, here it is. So let's start with a review of these debit and credit rules for this chapter 2 illustration problem. So again, you want to make sure you commit these to memory, right? We want to make sure that we have these down so that when we record transactions, we know what's happening. So the assets always have to equal the liabilities plus the equity. Debits on the left, credits on the right, right? Debits on the left, credits on the right. Debits on the left, credits on the right. Doesn't matter what kind of an account it is. Assets, liabilities, equity, revenues, expenses, dividends. Debits on the left, credits on the right. But the thing is, though, a debit increases an asset, a credit decreases an asset, just the opposite for liabilities, right? A debit decreases a liability, a credit increases a liability. Equity, same thing. A debit decreases an equity, a credit increases an equity. And if we look at expenses and dividends, well, those are equity accounts, but they're just the opposite. They decrease equity. The way you decrease equity is with a debit, right? So you're going to debit expenses. You're going to debit dividends. Revenue increases equity, right? How do you increase equity? With a credit. So revenues are normally going to have a credit balance. Expenses are normally going to have a debit balance. Dividends are normally going to have a debit balance, right? Assets are normally going to have a debit balance. Liabilities are normally going to have a credit balance. Equity is normally going to have a credit balance in general. So the increase side is always the normal balance in the account. That's what you should expect to see. So I've got 5 transactions that we're going to look at here. So in this case, we have the receipt of $50,000 cash in exchange for common stock. So cash is an asset. How do you increase an asset? Let me just scroll down here. You increase an asset by debiting it. So this first transaction on January 1, we want to make sure that we are increasing this asset called cash by debiting it. And now that we've recorded this debit, we need the amount. The amount of this transaction is $50,000. So we've got a $50,000 debit to this cash account. And what are we doing? Well, we are receiving cash and issuing common stock. Common stock is an equity account. We now have more common stock outstanding. How do you increase an equity account? By crediting it. So we need to credit this equity account that we call common stock. So again, remember we have to indent our credits, right? So we indent this credit to the common stock account. And again, the amount that we have here is $50,000. So we're going to go ahead and we're going to credit that account for $50,000. And number two, we have the purchase of land. They are buying land and they are paying cash for the land. Well, land is an asset. So now we've got to increase this land account because we've now got more land. How do you increase an asset? With a debit. So on January 2nd, we've got this debit to the land account for the purchase of land for $2,000. So we want to make sure that we debit that land account to increase it by the $2,000. And we're paying cash for the land. So paying cash means we need to decrease this asset called cash. How do we decrease an asset? Credit the asset account called cash for the $2,000. So we're going to credit that cash account for the $2,000. And the credit to the cash account is for the $2,000. Next, we've got the purchase of office supplies. Supplies is an asset. We need to increase that asset. How do you increase an asset? You increase an asset with a debit. So we need to debit on January 3rd this supplies account for the purchase. Let me see if I can't adjust that a little bit. We're going to debit the supplies account for the purchase of supplies for $3,000. So that purchase here for $3,000 for the supplies. So we are purchasing these supplies and it's on account. We're not paying cash. We are paying with a promise to pay $3,000 at some point in the future. So we need to record this liability. How do you record an increase in the liability? By crediting it. So we want to, of course, indent our credit to accounts payable for the $3,000. And we've got our credit to this liability that we call accounts payable for $3,000. The next transaction, we are paying for advertising expense. So we need to record the increase in the expense. How do you increase an expense? With a debit. So on the 4th, we are going to debit this advertising expense account for the $1,000. And we end up here with a debit to the expense account called advertising for the $1,000. And now we are paying $1,000. Well, we're paying with cash, and cash is an asset. How do we decrease cash? We decrease cash, which is an asset, by crediting it. So we have a credit to this, and we're indent our credits, right? So this credit to the cash account on January 4th, we're going to credit that cash account for $1,000. And we have a credit to the cash account for $1,000. And the last transaction, we are receiving cash. We're receiving $5,000 for services performed. So cash is an asset. How do we record on the 5th an increase in our asset? By debiting the account that we call cash. We're going to debit that cash account for $5,000. And that's a debit to the cash account for $5,000. And then we also have to recognize that we've received this cash because we perform services, right? That's revenue, right? We've performed services and we've got to recognize that revenue, those fees that we've earned, and revenues, an equity account. But how do we record an increase in this revenue account? With a credit. So we want to indent our credit to the fees earned account for this $5,000. And right here, we have a credit to the fees earned account for $5,000. So we've got all of the transactions, these 5 transactions recorded in our journal. So again, it's a list or a summary, a record of our transactions. And then the next step is to record the transactions in the accounts, the T accounts. So on the first, we have a debit to the cash account. And I'm going to use some notes so that we have a kind of a link back to each transaction that I'm posting. So I'm just making a note of the date over here in the margin. On the first, we've got a debit to cash for $50,000. And on the first, we've got a credit to common stock for $50,000. So a credit to common stock for $50,000. And then on the second, we've got a debit to the land account for the $2,000. And also on the second, we've got a credit to the cash account for $2,000. And that is on the second. And then on the third, we've got a debit to the supplies account for $3,000. And then also on the third, we've got a credit to accounts payable. And the credit to accounts payable is $3,000. And again, that is on the third. And then on the fourth, we've got a debit to advertising expense. And that debit to advertising expense is for $1,000. And then we've got a credit to the cash account for $1,000, also on the fourth. And then lastly, we've got a debit to the cash account on the fifth for $5,000 and a credit to fees earned for $5,000 on the fifth. So we've now recorded all these transactions that are in our journal. We've posted them to the ledger. All of these accounts, these T accounts, are in the ledger, and we've now posted them to the ledger. Now, the last step here would really be to kind of record, if you will, I guess what you would call the balances in the accounts. We want to know what the balances are in all of these accounts. So what we have here, if I could, let me see if I could use my pencil. So the supplies account, there's only one entry, right? So the balance is just 3,000. The land account just has a balance of 2,000. Advertising is a balance of 1,000, a debit balance. Fees earned is a balance of 5,000. Common stocks a balance of 50,000. Accounts payable is a balance of 3,000. But what's the balance in the cash account? Because you got 4 items here, 2 debits and 2 credits. Well, we've got to net all these, remember? So it's the 50,000 plus the 5,000 minus the 2,000 minus the 1,000 is going to equal what we call the balance in this account, right? So the balance in this account is going to end up being $52,000. That's what we end up with here when we take all of the items on the debit side and subtract all the items on the credit side. The balance in this account is $52,000. And kind of the last step here, if I could, would be to kind of prepare what we call a trial balance, which is just kind of a summary of all the balances. But we're not going to do that. We might see that in one of our assigned exercises. But for now, we're going to stop here with this step, which is just summarizing all of the balances in this ledger, which is a summary of all the accounts. So that's it for the chapter 2 lecture. Next thing will be the problems and exercises that I've assigned, and that'll be on the next recording. Take care.